Fine, we're going to get started. First of all, welcome everyone to another virtual event on the accounting design project. Today's speaker is going to be Shiva Rajgopal from Columbia Business School. He's going to talk to us about Do Technology Firms Generate Excess Profits, a paper co-authored with Anup Srivastava and Rong Zhao, both from University of Calgary. Before we go in, just a few ground rules. I'm going to be monitoring the participant section. If you would like to ask a question, please raise your hand. The speaker, Shiva, he's going to get first 10 minutes uninterrupted. And after that, he's going to open up for questions. Towards the end, we'll take a couple of minutes for him to conclude as well. And if you don't have a question, but just want to share a comment or something like that, use the chat feature because the session and the chats are all being recorded and will be made available to the speakers. So let's take it away, Shiva. The stage is yours.
Okay, thank you. Thank you to Ayung and Stephen for organizing this. It's always nice to. I mean, we've tried hard to make it a design type paper. We can present anything, but it's nice to stick to the mission. So this is a paper about measurement, and like most of my papers, it started with a reporter question. So a reporter once asked me, how much money do you think technology companies make? It sounds simple, but it's deeply complicated, as the audience here knows at least. So part of the exercise here is to try and do the best we can in trying to answer that question. And of course, it's a topical point. That's why the reporter was interested. It's all over the press. It's been very topical in Europe for a long time, as you know, because of antitrust concerns and so on. So you must have also seen the House report on investigation of competition in digital markets, where they've made claims that these companies make supra-competitive or supra-normal profits, and they don't actually quantify anything. So hopefully this is our entry into that space where whether you agree or disagree with what we do, at least we've got everything laid out very clearly, hopefully. And if it is not, tell us, and we are more than happy to go change things. And so at least there is some regulatory relevance to what we're trying to do, apart from being, I think, an interesting methodological conversation, at least for us accounting academics. The other reason this is interesting, and this is, the more I read econ and finance work, the more disappointed I get. So there's a raging debate in econ about this issue in general, that the US has generally become less competitive from a product market standpoint. And it's a very provocative conversation, but if you look carefully and open and read the method section, especially when they use financial statement data, you have to really wonder what these guys are up to. So there is a QJE paper, DeLocker et al., where they try to come up with price markups. So what is the idea here? That if the product markets are getting more concentrated, incumbent players can mark up more on their costs and sell products at a higher markup is the basic idea. How do they actually measure this? They're basically going to regress sales on COGS. Amazing. I mean, this is probably obvious to anybody who teaches accounting. How does that measure anything? So they measure sales on COGS. The thinking here is that COGS is a proxy for variable costs. And there's barely any conversation about intangible assets and so on. Especially in this context in technology, what does COGS mean for Facebook? What does COGS mean for Zoom? Who knows? And these guys don't really care as much when they run these regressions. It's cloaked in what looks like impenetrable math, but it's fairly basic. It's quite disappointing. The QJE paper is fun if you're looking for something in a PhD seminar to have a conversation about measurement. The second paper here, the Ayagiri paper, is a finance paper, and they are trying to compute ROIC, and they do this for the entire CompuStat universe, not necessarily for technology. And they come up with things like 200% ROICs for Microsoft. And if you look carefully at what they do, a lot of it is inspired by Damodaran. The IC, is kind of a strange definition. Both the numerator and the denominator are kind of strangely measured in this IRR paper. So they ignore taxes in the numerator. So this is basically pre-tax, which is kind of strange. In the denominator, they'll take out current intangibles, but they'll ignore assets that are not in PP&E or current assets, such as IP, R&D, and so on. So, in the numerator, they add back R&D, and they do some depreciation, but they don't depreciate acquired intangibles. So lots of arguably interesting, important detail that our literature has worried about somehow is not really, captured by the others, especially in finance and econ. So this is the other reason we're working on this. And before I go forward, I should, thank Anup and Rang, without whom nothing would be possible. Anup's worked on intangibles for a long time. Rang, I'm still trying to grapple with what we have done in this paper. So they are going to answer all the hard questions because there's a lot of deep methods here. But anyway, so from a practical policy standpoint, the House report and the other conversation gives us an entry into why we should look at this question. From a literature standpoint, especially in finance and econ, and I think this is a rich area that we want to work on, and hopefully others will as well. A lot of the measurement is very flaky, and they just get away with it, and nobody seems to, push back. So this is partly our intent as well in this paper. So what do we do? So, you guys know the usual problems with, broadly anything you may call an accounting rate of return, ROIC, ROA. We have, for other reasons, we have GAAP rules on revenue recognition, depreciation, intangible expensing, which we don't want to necessarily go into here, but those things distort anything close to economic return. Not that we can really measure economic return well. These are all attempts to get there, right? So the audience by and large knows the issues with so-called ARRs. So what do we do? So I've been a fan of this old Baber and Kang paper for a very long time. And I was reminded of it when I was talking to Trevor. He's on the call. So the Baber and Kang is sadly, I think, a paper that doesn't get as much attention in accounting academe. So these guys, this is Bill Baber and, Sokyo Kan, hope I'm not mispronouncing his name. So they were commissioned by the Office of Technology Assessment a while back in the early 90s to go and answer a similar question in the context of the pharma industry. So the idea was, do pharma firms make supranormal profits? And it's a paper, I think, is JAP? It's sadly, I think, criminally, I would argue, represented in PhD seminars and so on. It's an excellent paper. So all we are doing here essentially is, resurrect that work and modify it a bit and try to apply it to technology. So in that sense, we are basically just borrowing and stealing, but hopefully it's with new data and more relevant to the conversation. Inspired by some good theory work, my theory colleagues are not on, and especially John Glover would appreciate this. Lots of work by Ijiri and then Jerry Solomon. So what is this IRR? Like, I'll just take a couple more minutes and just lay out the method. And frankly, it's quite involved. So it would be nice if you have a chance to read the paper. I know it's very hard, but given the 3-4 minutes I have, I'll try. So the advantage with the IRR is that it takes a longer run perspective. So let's say you make an investment of $100 and you have to assume some kind of payback period. Of course, there's subjectivity in the payback. So we've assumed 9 years. We've modified it to 4 and we run lots of sensitivities in the back. So the idea here is, let's put in $100, and then you also have to assume a profile of the recovery. So what is called the Q1 profile is the following. It basically assumes that nothing comes back to you for the first 3 periods, and then cash recoveries are fairly large, and then things kind of peter out. Okay, so it's basically this kind of recovery period profile. Of course, there is subjectivity. I'm happy to admit that. Of course, there is subjectivity about, what the profile it really looks like. We don't know because, as you know, that every company has a series of projects, and the numbers we get to look at the end are some kind of aggregate average of these projects. the other interesting thing about IRR, it's fairly cash-based. And it's also meant to recover the capital involved. So IRR is, roughly speaking, broadly what IRR is, right? It's the rate of return such that the $100 investment comes back to us within a specific period of time in the future. Now, if you add these numbers, that's roughly $370. So you have to return capital, and the rate that would equate these two cash flow streams is basically the IRR. So what are we going to do? We're basically going to compute IRR for a set of firms with some filters. So for instance, we only stick with, actually before you go there, let me just show you a little bit here in terms of what this would practically look like. So let's say we make a $100 investment in year 0. Let's say the rate of growth in the investment is $5. So you have 105, 110, 116, 122, and so on and so forth. And if you saw the profile I put up a while back, $26, 53, and so on. For every investment here of $100, you'll see something that looks like a waterfall of that profile. So as you go further and further out, let's say year 10, your the cash recovered in year 10 from past investments is $377. The cumulative investments shown in red are about 1258. So the cash recovery rate, which is related to IRR, which given my time constraint, which I'm already over, I'm not going to go into, is broadly 30%. So this is what we are trying to estimate from the accounting data. The details of estimation are here. So broadly, IRR is cash-based. Our investments, I should also point out, are undepreciated investments. So this is like the gross investment. We also capitalize R&D for the last 5 years because to deal with the intangibles issue. Capitalize 50% of SG&A. This is coming from Anoop's management science paper. The cash recovery is broadly the indirect cash flow statement, the operating cash. We add back R&D. We add back 50% of the SG&A that is not expensed. We take out tax payments. We also, it's a minor point, but we add proceeds from the sale of property and investments. That's our numerator. The investment denominator is undepreciated assets, to be clear. And then we compute these things for a whole bunch of firms. Let me talk for 1 second about our data. So we start with the entire CRISP CompuStat database, get rid of utilities and financials and real estate firms, get rid of firms with assets less than 100 million. So we get rid of small companies broadly. There is survivorship for sure, because the IRR method requires you to have some time series. So that's another constraint. And we are left with about 6570 firm years. We compute IRR every year. Just give me 1 second. I know I'm over. So let me summarize what we find. So in general, we can talk about the details. There are lots of nuances here on how to think about return for technology firms. What we do find is that IRRs, we set out to ask whether tech makes supernormal profits. What we are finding is that it's actually healthcare. So healthcare is the sector that has the highest IRR for the last 3 decades and is a very close second in the previous decade. Superstar tech firms do appear to earn IRRs of 30 to 40%. Interestingly, these IRRs are already falling, which is interesting. Yes, there are limitations. We can discuss, the measurement issues with the superstar tech firms. So the broad contribution is we are at least, placing some quantitative empirical ideas on the table in terms of measuring the so-called supernormal stuff. And hopefully it's an improvement over econ and finance work. So I'll stop there and go wherever the audience wants to go. Thank you for indulging me. I know I'm about 2 or 3 minutes over.
Yeah, Shiva, the first question is from Professor Steve Penman.
Yep.
Steve?
Shiva, how are you doing, fella?
Hi, how are you? Thank you for doing this. Thank you for coming.
Yes, it's a good enterprise endeavor, I think. Listen, your logic escapes me a bit. You start off criticizing the finance people because they don't handle the accounting correctly, okay? And then you throw out the accounting. And you go to cash flows with all these assumptions on gestational periods as clients that make me really dizzy. rather than asking what an accountant would do, how can I actually get an indication from the accounting numbers?
It's a good question. So in the back end, we do talk about ROICs. Now, to answer your question in depth, Stephen, left to me, I would, if I were the standard setter, I would let firms discretionarily capitalize R&D and SG&A. To me, that is the only way to get some sense from an accounting gap standpoint on getting close to something resembling an economic rate of return. There are all kinds of problems. One of the issues I was talking to Quinn last night about, which we haven't dealt with, frankly, is a lot of these tech firms, Stephen, as you know, stock option expense, right, is an accrual that doesn't get trued up in cash. So have we really accounted for compensation expenses correctly for the tech firms? No, So, but anyway, that's my attempt at an answer.
Well, I think you've recognized some issues with GAAP accounting, okay?
Right.
And you can say, look, let me do good accounting, which is the accounting design project is all about. For example, Anup has a paper where he actually extracts sort of the capitalized portion of SG&A. I'm not sure he does it correctly, mind you. It's an estimate. You criticize revenue recognition. Don't tell me you want to recognize revenue before you get customers. So you can go back and you can. I teach a case in class where Amazon, where they have a line there called technology platform development. It's very clear. Strip it out and then capitalize it if you wish, and you get a different measure of the ex post return on investment. As you say, you're going to run into problems, and it'd be very helpful to document those problems, and then to say, look, the problems are so bad, I'm going to actually go and do an IRR, which in my mind has a hell of a lot of assumptions that I can't put into the pocket. Okay, you see my thinking?
No, I totally agree, and I expected you to say this, and this is helpful, because we have never presented this paper before. So there are other problems too. Let me add to the problems, Stephen. So for instance, Amazon claims it's the largest spender of R&D. And somehow I doubt that. My wife used to work for Amazon for a long time, and I had her ask around. So it turns out that they combine the technology and the content spend in R&D. So buying shows for Amazon Prime Video to me is not really R&D. So do they disclose that separately? No. So
yes, I think that's right. You may run on fine. I would like to be able to make these adjustments, but under the current reporting regime, I cannot get the disclosures. I cannot see what's in SG&A. Please tell me more about that.
Absolutely.
And that is that would be the frustration, that if I could get these things with more disclosure, I might be able to get a horse race between the accounting extraction and an IRR, where of course, as in accounting, we're making estimates. There's a lot of estimates in your IRR.
No, true, absolutely. We acknowledge that fully.
Yeah, okay. I'll stop, but I think this would be a nice way to go. To the extent to which you can actually do it through the accounting, or you can it's hopeless. It leads you to more accounting design inferences about what you need to do that, or whether you just have to abandon the whole thing and go to IRR. That would be a very nice paper.
We will go back. We actually have tried a little bit, and we constantly struggle with how much to go into individual companies versus keep it quote unquote somewhat big picture.
Yes,
it's a hard process, and if our okay, I agree that two wrongs don't make a right, but Stephen, if you get a chance, do look at these econ papers and the preposterous claims they make. So
no dispute there.
And these are the people on the policy table. We are not on the policy table. That's the other frustration that Anup and I have, that we should at least put something out there that corrects some of these absolutely bizarre numbers that these buggers come up with no conversation. And but I agree, to get to your world, we'll have to think harder. Maybe we should write a series of cases in the appendix, perhaps, as a way to reconcile your word with our word.
Yes. Mm-hmm.
But we'll try for sure, because I'm interested in getting to the right answer, not a answer.
I'll let you go.
Yeah, thank you, sir.
Sorry to interrupt.
No, it's great. That's the whole idea.
We have a question from Sudipta. What about compensation, especially stock options, given that human capital is really what drives this?
Oh yeah, as I acknowledged very openly, let me show you the measurement here. What do we do? So what about compensation? Well, it's here. Correct me if I'm wrong, Anup, but we're subtracting the accrual based estimate of equity comp. Right, Anup? So, just to be clear before I go forward.
So part of compensation is reflected in R&D and SG&A?
That too. That's a deeper point. So before we go there for a second, the operating income before debt here takes out accrual-based estimates of equity comp, correct? Yes. Now, there are several issues. As Anup rightly said, some of the comp expense is sitting here in R&D and some of the comp expense is sitting in SG&A, absolutely. So to the extent we add it back at some level, we are assuming it's quote unquote worthy of capitalization. There is another point which is beyond the scope of this project, which Trevor and Quinn and I are working on. What about the actual cash that leaves the company because of equity comp? So we've done a lot of work for 4 years and we're getting close to an answer. And what we are finding is that the cash payment is at least 2x of the accrual number. And that is obviously going through treasury stock because of stock buyback. So that's another problem we haven't touched. So Sudipta, you're right. This is what we have done. What else could we do? Maybe some kind of ad hoc estimate of the actual cash that leaves the company because of equity comp might be one way to go. Although Anup won't let me do that.
So it's both a numerator and a denominator problem though. So it's sort of, there's an issue on both the numerator and the denominator. You're focusing on the numerator part, which is good, but then it also has to sort of fall into the investment part as well. And so,
say more, because the investment here is just assets. It's not equity, unless I'm misreading your comment.
Yeah, but it's sort of you're paying for investment in the people, right? I mean, you're giving them options as a way instead of cash. But if you think of human capital as being the real investment in these companies, not PP&E, which is what you were saying, right? The whole R&D thing.
Okay, sorry, go on. Sorry.
So the whole they're investing in is basically the developing of the human capital, right?
Okay.
And so that's what you're trying to measure indirectly through the R&D and SG&A, right? But ultimately, even though we would not put it on the balance sheet under any state of the world, I think, implicitly what they're investing in though is in this human capital. That's where the investment is.
Absolutely right. But there's a slight pushback. Slight pushback there. To the extent the stock comp is in R&D and SG&A, we have capitalized some of that. Now you may not agree with it. Yeah. So,
I agree, but not all of it.
Certainly
some
not.
Of it will flow outside that, right?
Yeah, I'm struggling to think what that might be for a technology company, right? What kind of stock option expense or RSU expense is unlikely to be in R&D and SG&A? Am I missing something?
The CEOs, will it go through R&D or
totally.
SG&A?
It'll be in SG&A for sure.
Shiva, can I respond to that?
Of course, Anu.
Yeah, so let's put it this way. That's, my JE paper shows that the composition of, let's talk about operating costs. The composition of operating costs between so-called cost of goods sold and SG&A has changed over time. And SG&A includes R&D and advertising. So most of the costs, think of Facebook. What is COGS for Facebook or Zoom? The point was brought out. It's most of the costs are flowing through SG&A. And within SG&A, we're trying to find out what is the investment component. So to the extent that most of the option expenses are flowing through SG&A, whether it is on human capital, whether it's on marketing, whether it's on innovation, whether it's on top talent, it is flowing through SG&A. Granted, it's not 100%. Maybe part of it is flowing through COGS, but COGS is a very small component.
Exactly. For tech companies, I'm not sure. You're probably right about the other sectors that we benchmark this to, which we should go back and think a little harder about. At least clarify for the reader the portion of COGS, rather the portion of option or equity expense that is potentially not captured. We'll definitely go back and at least find that number as best as we can and do something with it.
I think, can I interrupt again? I think you're missing something here. Under what you're capitalizing is the grant date expense for an option.
Totally.
And that may never be an expense if in fact options never go into the money. But if they do go into the money, and for these tech firms, they go into money a huge way, there's no cash outflow from the firm. It's just the shareholders lose because their equity gets diluted. They get paid, you pay your employees in shares, okay?
No, Stephen, what about the buybacks? A lot of the buybacks, this is what I was referring to earlier, a lot of the cash buybacks are effectively meant to support this option program.
No, that is totally wrong.
So where's the equity coming from?
A buyback does not reverse the dilution for stock options. If you buy back your stock, which has hit the roof, and the employees have exercised, and you're buying back at that high price, you're actually further diluting on a buyback because you buy back stock, which is highly priced, you dilute the shareholders, okay? It doesn't reverse the dilution from issuing shares from stock options.
Can I just interject for 1 second? I think it's not going the right direction because we're not looking from equity perspective. We are looking from company's perspective. Okay, so let's look at from the company's perspective rather than whether it is financed through debt or through equity or dilution or whatever. So we're not talking return on assets. We're not talking return on equity. We are talking return on assets.
No, but Anup, Stevens,
stock options should be out altogether then, because if you pay shareholders' paper, you don't affect.
You can't ignore stock options, right, Anup? To be fair.
I'm not disagreeing with.
No,
that.
you can't. But Stephen. Maybe I'm misreading you, but do you have an EPS idea in mind? Whereas, you know what? Let's table this conversation, Stephen. We are very close to writing the other paper, and if Quinn and Trevor want to jump in, I'm not saying they should, but if they want to, it's relevant to our work here. But
so go ahead. I'm sorry.
No, it's okay, Steve. Okay, maybe I shouldn't put them on the spot. Okay, that's fine. But you're right. You're right about all we have done here is to take the accrual component of the stock option expense. We haven't done anything with the cash. That much we can show you and go. Money, are there like a whole backlog of questions? Sorry, I'm not monitoring the chat.
Shiva, if you're okay.
Yes, please, of course.
First one from Ayung Sang.
Ayung, yeah. Ayung.
Hi, Shiva, Nup, and
Hello.
Ron. Really like the paper. Yeah.
You should have this longer, by the way. 60 minutes is like.
Yeah.
Well, I think we're dealing with limited attention. I believe
That's
you
true.
have one of them.
As long as they're around,
And I'm sure there's another new paper about COVID-19. People's limited attention has exacerbated.
COVID-19 infection, I'm sure there's a
Yeah.
okay, tell me.
So I really like the discussion in the paper when you talk about a company manage a portfolio of projects, right? And each project will be something you illustrated with a cash outflow as an investment in the beginning, and later on will be cash inflow.
Let me go to that slide,
Yeah. And my question is kind of like more about how we interpret the results, because here I think you are calculating CRR at the firm level, but each individual projects would have IRR, and also across projects there are different kind of growth rates across firm. So I just don't know whether the results tells us those tech firms, especially internet tech firms, has a higher profitability in terms of IRR, or just higher growth in investments. They just investing in at a faster speed compared to low tech firms or healthcare tech firms. It's just an interpretation of your results.
No, this is an interesting point. So you're saying, is it driven by quote unquote return, or is it driven by
growth,
investing in R&D at a higher and a higher rate?
Yeah.
But if the latter were true, let's go back to measurement. Shouldn't it hurt the denominator? It'll increase the weight on the denominator, making it a bit harder to show some kind of rate of return. Is one point, right? And
yeah, but if you go back to one slide earlier, just that
sure.
simple example you have.
Simple example, yeah, okay, got it.
Yeah, the CRR.
Yeah, okay.
You can already see that CRR is actually higher when the firm has a growth rate of 5. So you can simply just consider investment growth 10%. A simple simulation, I think you will see CRR actually, the distance between CRR and IRR will be actually wider when the growth is
not true, because it's okay, unless I'm misreading or misunderstanding what you're saying. The growth rate is making the denominator heavier also, correct?
Okay.
So you have to recover more if you invest more. That is one response. And the other response, I didn't cut paste this into the slides, but we ran a regression somewhere where we compare ARR and IRR and try to tell the reader what exactly is in that number. Sorry, I should have. No. If you have the paper, I want to respond to your question. If you have the paper, look at where is that now? Table 9. So in table 9, we try to present evidence on what exactly drives the difference between ARR and IRR, which gets to what you're saying, right? And R&D growth, of course, this is a multivariate regression, subject to all the caveats there. R&D growth is actually negatively associated. More often than not. And in many cases, it doesn't load. So especially for the high-tech world, it doesn't seem to load at all. So it's not quite right, even from an empirical standpoint, and even from a logic standpoint. But you're right, that's what we see for a company like Amazon, that R&D is kind of doubling or something every year. So it does lead to the suspicion, is it investment growth? So we talked a lot about this, and unless I'm mistaken wrong. Does that make sense to you?
Yeah, we had this discussion. So it's not just biasing our numerator, it's biasing our denominator as well. So it's not biasing our results in favor of what we see here.
Somewhere. Sorry.
So Shiva, can you show that formula?
Okay, I'll try. Is this?
Yeah,
my head hurts, man. Okay.
Okay, so anyway, I think in a way, G is incorporated here. Growth is incorporated here. So it's both in the numerator as well as in denominator. Look at the second term. Yes, I think you're right that yes, cash recovery rate would be affected by the growth. But IRR, in a way, IRR, I think, let me bring out one point that Shiva has emphasized earlier, but let me elaborate on it. And that is about which you brought out, that there are a company's a portfolio of multiple projects with different paybacks. In a way, this formula, by taking about 9 or 10 years perspective, is letting the data play out. It's letting the data play out. You know, if it is, we are assuming that the recoveries occur over 7 or 8 or 9 years, but it actually does not matter. If there is no recovery, then data sort of takes that into account. So it is assuming, this formula is assuming that investment is growing. And by the way, everything is inflation adjusted. Let's point that point. Let's bring that point also. But in a way, the formula sort of lets the data play out. So if there is growth, it is already incorporated in this formula. So it's
but Ayum, if I may add, to get to your word is, as you can imagine, close to impossible unless we start, reporting segment by segment. It's a classic tension between granularity and aggregation, right? The whole point of summary financial statements is a summary. Otherwise, we can give you a transaction book, right? So where do you draw that line has always been the challenge. So I can't get to your deeper point that you want information by projects. I don't know how to do that. We could do this by segment at best, is the closest answer I can give you. But again, data limitations are a huge concern. Segment definitions are not uniform, and
Yeah.
But I see your intuition, right? It will be fabulous to do this for, say, AWS versus the retail segment of Amazon. And if we had data, we could probably, we even talked about that wrong, correct? But the data was a concern.
Yeah, again, yes, you mentioned earlier, we can perhaps look up some companies and write up some cases. Large sample basis, I don't think it's feasible.
Because of the segment issue, right? Because it's not consistent and so on. But we should, at least for the 5 big tech firms, think about some kind of additional write-up along the lines Stephen suggested.
What about discontinued operations or disposals of segments? You would have the book values there that are being gotten rid of. You would have some market valuation of those future cash flows. So that would give you at least some idea of what the IRRs are on those projects, right?
Could we? Because even when you, Sudipta, when you see these impairments,
I'm thinking more about discontinued operations.
Discontinued ops.
So the things you're selling off, right? So you have the book values because they're going to be reported separately in the balance sheet or in the notes. And you have the sort of market values when they do get disposed.
Okay, we could think of that, but that's again just the exit value, right? So that what do I do with how does that asset perform when it is with the business?
Well, you have, after the decision, you still have 6 months, a year, 2 years till they dispose, right? And they have to make the projections till they dispose, and then you see the actuals as well.
Okay.
So it's not a long
huge
period,
endogeneity,
but
I mean,
how
do you extrapolate?
It's better than segments, I think.
Maybe, but I have a snapshot into their last few years. That's it, right? I mean, I can't extrapolate from that back into the past because these are self-selected by definition. That's why they're getting rid of them. They're not doing well, right? Am I missing something?
Yeah, but they are flows, right? I mean, so.
But where are the flows reported, right? They're not reported unless it's a separate segment that got disposed. If that's what you have in mind. Okay.
I mean, that's the only way it gets as a discontinued operation.
It has to be reported as a separate segment? I didn't know that.
Typically, that's what the level is for a discontinued operation.
Okay. I didn't know that. Okay.
Shiva,
you've been wrong. Do you want to add anything at all? Oh, sorry.
Well, so I was just thinking, by the time you have the data, they have, as you said, endogeneity issue, right? They already made the decision to sell off that subsidiary or segment. So what happened before that? I don't know.
But Sudipta claims that there has to be some segment reporting for it to be reported as a discontinued operation. I didn't know that, but we are happy to go back and look if there is something. Because this is a question I've struggled with in a different context, Sudipta. When people, when companies buy other companies, I'm positive that the incremental return on new capital is not good. But isolating that, unless it's a very big acquisition, is very hard. Even if it is a very big acquisition, it's pretty hard. Like, Walmart just got rid of Asda, which is underperforming for years. But, unless I can actually go back and recreate Asda's P&L and what Asda did to Walmart's balance sheet and income statement, which is frankly quite difficult because they hide it very well.
So take the example of Facebook, right? Facebook's acquisition of Instagram or WhatsApp. I'm not sure that they would have separate reporting for Instagram or WhatsApp on Facebook's financial statements, even if one day down the road they decide to get rid of these two.
That's what I thought too, but maybe I'm wrong. I'm happy to go back and check.
I don't think they'll be big enough to be reported as a segment.
Well, even if they're big enough, they may not want to show you, right? They've just started showing you YouTube's numbers in Google.
Can I make an economic point here? We are talking about, where did the research question start? It starts from the fact that these guys are killing the competition. That's the whole argument, right? And a part of killing of the competition is to acquire a competition. So the portfolios, by definition, WhatsApp is sort of cross-subsidizing Facebook, if not cross-subsidizing, it is helping you to control the market. So why do we need to calculate the profitability separately for WhatsApp or for, I think the point I'm making is the research question comes from anti-competitive practices, and part of it involves acquiring a competition.
No, but Anup, I mean, it's from a methodological standpoint, if you want to, as accounting professors, we're probably interested, right, in trying to get to the big unit level in a company, let alone segments and so on.
Okay, that part I agree, but I'm talking about if I relate it back to the research question where we started from. And the second point is, if we already have so much issues with IRR,
you're not going to buy anything we say anyway, right?
Pardon?
You're not going to buy anything we say anyway.
No,
but that's okay. Look. But that's the whole point, right?
Yeah.
I mean, look. I mean, if you want a love fest, we shouldn't do an accounting workshop. People will hate everything you do. Haven't you learned this by now?
Well, that's why people love me so much, right?
That's part of the fun. That's why it's fun.
So with the carve-outs or spin-offs, though, wouldn't you get financial statements for the last 2 or 3 years going backwards? Don't they have to provide the retrospectives that you could look at once they sort of issue shares again? So whether it's a carve-out or a spin-off, so you could get some information going back?
But here, if I were to, maybe you do, but all we are seeing in these big segments is consolidation, right? It's the opposite, unless I'm missing something. We rarely see carve-outs or spin-offs, right, Anu? And Ram?
Yeah. In fact, you remember the SEC love fest with Google about YouTube's reporting? They just wouldn't report.
No, we rarely see spin-offs or carve-outs, to answer Sudipta's point, because a lot of this is consolidation. In fact, the whole econ interest in this topic and the policy interest probably started with consolidation. But let me show you some numbers. I guess we should show you at least something, right? So these are the ARRs, the so-called accounting numbers. And to be fair, I mean, health is doing pretty well here as well. The matter is, it's all about scale, I guess, at some level. It's anywhere between 12 to 14% for health. For technology, digital high tech that we call this, it obviously crashes with the .com situation. Here again, survivorship is a concern, because we impose this idea that we need at least 6 years of data, as we acknowledge very openly in the paper. The firms that took a lot of risk and died are not here. So that's the lottery ticket payoff type numbers, which we don't know what to frankly do about that as such. But if you repeat this with the IRR world, what is interesting is that look at the red graph here. This is health. This to me was the surprise, because maybe it's not a surprise to you. I went and dug up some other data on health, and I'm happy to share it offline with anybody who wants to look at it. It's just shocking. I mean, maybe it's not surprising, but if you actually put this down in numbers, what I learned was, if the US were to have Switzerland's level of spending in healthcare, our median household income over the last 15 or 20 years, the growth in that number would have doubled. So health is a serious policy issue, which I hadn't fully appreciated but for this paper. So in terms of my internal prior revision, that's what this helped me understand. Technology, which is the blue line here, predictably starts taking off maybe in the last 10, 15 years or so. And as I said earlier, health is a close second below technology, which is interesting to begin with. Now, on the other end of the spectrum, look at this so-called stable tech. I know our labels are not great. What is stable tech? Sometimes I have to refer to it myself, but maybe Ram knows this off the back of it.
Call it medium tech.
Media, okay, whatever.
Transportation,
stable tech,
for example.
Transportation, aerospace, chemicals. That's interesting. So those guys are, frankly, languishing. It's kind of fascinating. So this other idea that IRRs are always bigger than ARRs, not quite true. So for the so-called stable and low tech, there are years where the IRRs are actually slower than the ARRs, which is, again, worth thinking about a little bit.
Shiva, we have a question here.
Yes, please.
From Oliver Binns in Seattle.
Hey, Shiva.
Hi. Hello. We've never met, Oliver. How are you?
Good. Nice to meet you. I just had, just a very basic question. So to kind of get to abnormal returns, would we kind of need some form of measure of normal returns? And how does the IRR approach?
That's a good point. So the way the literature has worried about this is that they try to benchmark this to cost of capital. Now, I know that's a rat's nest. Who knows how to measure cost of capital? But we have done what we can. I'm not even sure I have it in the slides here. So, so the gap between the cost of capital and the IRR is roughly considered to be one way to address your point. And that's another interesting conversation we can get into, right? After quantitative easing, treasury yields have kind of plummeted. So debt is much cheaper in any case. So the cost of capital for the firm has fallen quite a bit. So to answer your question, the cost of capital is actually going the other way, meaning it's falling as the IRRs for tech are rising.
I guess I was wondering so like when you look at aggregate cost of capital, yeah, for sure. So just to kind of see which industries are rising more in their rent extraction or whatever these reporters we were starting this conversation with want to get to, I was wondering whether we kind of see like increasing divergence there for some of the industries. So in particular health, like is it maybe true that the cost of capital for health is falling less quickly than others, or I was just wondering, did you?
I don't know whether we've done this by segment, and I'm not sure how well we would capture that. But cross-sectionally, for the whole economy, as you know, it's falling, right, quite a bit. We could maybe perhaps it's already quite cluttered here, but we could probably plot a cost of capital comparison, if you like, by sector. But the big story there, I think, is it's the macro effect, right? Bond yields are so low, especially post-quantitative easing, especially now, that we again, this is a chart I don't have, but we do this and show you this for the big tech giants. The cost of capital is barely 8%-ish, 7, 8, and so on. That's stable 6 at the very end. And we also show you evolution over time. Now, Ram, did we show an evolution over time for all the sectors? I believe we did not.
At some point, we did have a plot, but we did not include it in this draft. Because if you look at the graph, basically, you're just going to see the effect driven by treasury yields. So,
that's what I was trying to say. So, I mean, you can do some firm level tinkering if you like, but I'm not sure it's going to matter that much, because the macro story is actually quite compelling. Cost of capital is by and large down.
So there's no big variation in industry-specific risk premia that we would kind of see.
Well, put it differently, if you do that graph, you're going to see a similar pattern that you are observing here on IRR.
So Oliver, we have not done very fancy risk adjustment to be candid, because I frankly don't know whether to believe those things in the first place, right?
Yeah, so the data on weighted average cost of capital is kind of rough. That's one of the reasons that we probably did not talk too much about those results.
So we calculate a WACC, the classic way, right. Have we factored in all these? My worry is, how do I ever validate that? I don't know. A lot of these finance guys put these cost of capital numbers up. Do they really know what's the right answer? I've asked a lot of CEOs, by the way, and CFOs. They don't know sometimes what their own cost of capital is. They can tell you what the cost of debt is. They can tell you their hurdle rates. But if you start asking them, what's the cost of equity capital? They say, look, I think about stock price. I don't think about cost of capital. So it's commingled, this numerator denominator. This is a rant and a digression, but I think a lot of that is an invention by the academic community, trying to separate the numerator and the denominator. I'm not even sure it's possible to do it well. At least the practitioners, at least the CFOs, I can tell you, don't seem to know what their true cost of equity capital is, for whatever that's worth. Money? Sorry.
Oh, you're good. You can proceed. Sure.
Yeah, I can proceed. Stephen, sorry. Anyway,
it's just an aside comment. I totally agree. The idea that you can fit the complexity of the risk into one number is a total fantasy. You can do it by assuming normal distributions or statistical assumptions or something like that. You can do it. But in my mind, it's a total fantasy. You've got to do some basic, solid, fundamental analysis to actually get a feel for the risk, but actually get that into, let's say, risk and uncertainty, let's say, to get that into one number, pretend the cost of capital is 8.3% and not 8.5% is a fantasy. We need to recognize that in our research. Just an aside.
Yeah, but do students listen to me? No, they go to Damodaran's website and download stuff and run it anyway. But having said that, let's move on. So we do a lot of these cuts. That's the big picture idea. So let's spend a little bit of time worrying about the so-called tech giants because we have 10 minutes. Tech giants defined as firms with a market cap of more than 500 bill. These are the classic big names, Apple, Microsoft, Amazon, Alphabet, Facebook. These are the ARRs. These patterns are familiar to most people. Amazon was pretty low and then it comes back up and most of their profits are in the last 3 years. With IRR, though, it's quite interesting because Amazon does look pretty healthy. All these guys are in the 30 to 40% range, as I said. What is also interesting from the antitrust perspective, a lot of these numbers are actually falling. So it's quite, I mean, this is speculation, but I wouldn't be surprised if the antitrust people are coming in when some of these so-called supernormal profits are being squeezed out anyway because of competition. So that's something worth pondering about, although I don't have evidence to that effect here. I can just tell you that the IRRs are in the 30, 40% range, which look big for sure. Then there's always this conversation about.
Shiva, can I just one point?
Yes, of course,
30 to 40% on a bigger denominator. I think let's not forget the bigger denominator part.
Yeah, but there are other caveats, right? I mean, we haven't properly accounted for option comp. And, to be fair.
Nevertheless, it's on gross undepreciated.
Yeah,
capitalize R&D and SG&A.
Subject to our measurement limitations, right? Absolutely. Then there's always this conversation about maybe Tobin skew is a better proxy for economic rents. I personally don't think so, but the economists love it. So they do it. So we've just done it at least for comparison. So it does look like IRR does have quote unquote greater value relevance on top of ARR for every segment. And we've run this together as well. So I won't spend too much time on this. Again, the need for benchmarks. So, Rong did some heavy duty hand collection. We went back and looked at every company that's been pulled up by the DOJ in the past. Now, I want to be very clear. The DOJ doesn't necessarily only use profit numbers to go after companies, but we thought it would be helpful to at least provide some kind of benchmark. And if you look at the data, the DOJ has gone after these 55 companies in the past, and we have data in the paper. Their IRRs are pretty modest compared to the IRRs that the tech firms report. So this is just another data point to add to the conversation. At no stage, sadly, can we say in this paper whether these are deserved or not. I don't know, because you could argue that these are rents to innovation, or you could argue that these are, they're somehow indulging in anti-competitive practices. I don't know which is the case, but this is at least some comparative data on what the DOJ has done in the past. The IRRs are pretty modest for the firms they've gone after in the past, relative to the ones reported by the tech giants. Okay, 7 more minutes. We do a whole bunch of, cuts. If you don't like 100% of R&D, we do 50% of R&D, 25% of SG&A. We change our payout horizons from 9 to 4 and so on. Now, one of the limitations is that we assume the same payout range for every industry that we look at, which is potentially a problem. But the downside to not doing that is you lose comparability. So we struggled with this and frankly didn't figure out what the right answer should be. We have a couple of other profiles as well. The Q2 profile simply assumes uniform returns in terms of returns to projects. And we agree that IRR has a lot of problems, but at least the cash payout profile is explicitly laid out. In an ARR, I don't even know what's going on. It's some mishmash somewhere, as our conversation earlier revealed. So we're at least there is some transparency here in my mind, which is one of the nice things about IRR, in case my co-authors think that I've massively undersold our project, which is fine, but jump in if you think that's the case. This is Stephen's other point. Is there a way to use the existing data gap given data somehow better? So we try the ROIC world, and we have details in the paper on what exactly we do. I can assure you it's better than the ones that the finance people use. What kind of conclusions do we come up with? Even the ROICs, to be fair, for an Amazon are not that high. For some of the others, now let's see, what is this? This interrupted time series is Facebook. Everything's falling is also something we don't make enough of in the paper. I think the trend is interesting in general. It's either stabilizing or falling. So it's not on some kind of 45-degree slope. But of course, the time series is limited. There are all those limitations, subject to those caveats, but it's still interesting. So last 5 minutes, unless somebody has questions. And I'm obviously happy to chat offline or whenever, if you like.
So Shiva?
Yes, sir.
It seems like survivorship is a really huge deal here. Like
Yes.
you said, winner take all markets.
Yes.
Can you sort of plot the failure rates by industry and correlate against this? So, each year, what fraction is dying? And
it's a good
how
idea.
Is that?
Yes. Happy to do it. Yeah, that should be easy to do. Yeah, and you're right, because if you look carefully, these industries are at different points in their evolution in any case. By definition, if you're low tech or stable tech, you're going to have lower rates of attrition.
Yep.
Health, because of regulatory issues, you're probably going to see a fair amount of consolidation anyway, especially after Obamacare. Tech, you're right, you probably see more of them dying. And
even in health, the biopharmas are going to have high selection bias, right?
That's a fair point. Yes.
So I think that you need to sort of incorporate that somehow into the analysis in terms of, so, I mean, the crude way is just look at those failure rates, but then a sort of longer term thing is to just put 0 in for future years. You have this moving 6-year window. So whenever they fail, then you start putting in zeros.
No, it's an excellent idea, because you could easily interpret these so-called high IRRs that we complain about as just a compensation for failure. Totally. Right. Yeah. That's such a nice idea. We talked about it, didn't quite know what to do with it, but I think you've given us a path forward, because we just thought about just documenting the failure rates, but adding zeros, etc., might be one way. And you can refine this point, Sudipta, right? For example, if you have an acquisition, you could use the consideration for the purchase as the terminal dividend, right?
Yeah, that's part of the discontinued operations part of the point.
Yeah. And delisting returns, hopefully you can trust the whole Shumway thing in CRISP. Okay, well, we'll certainly do that. There's another paper I have, which, Stephen and my Columbia colleagues are going to hammer me again next week, where we try to compute lifetime earnings for a company. And in that paper, we ran into all these problems, and we tried to do that. So we could bring some of that thinking here as well. But at least if nothing else, I'm at maybe a late stage of my career, I'm just understanding how complicated measurement really can be. And frankly, how interesting it can be, because I've never worried as much about it in the early parts of my academic life. So anyway, we have like 2 minutes, unless somebody has something just to wrap up. What did you learn from all this? As I said, I just learned, the question is not as innocuous as it sounds. How much money do tech firms make? Of course, I lost the reporter. Once I got into all this, he was not interested, as you can imagine. It's too complicated. But it led us down at least an interesting path, I would say. If the finance econ work that I had never read, which is quite dodgy. So I would request people if they're interested to follow up on that, because I think we as a profession don't sometimes push back enough on the econ finance folks. IRRs provide another perspective. Of course, they're full of assumptions, but so are ARRs. Can we improve on them without big disclosure reform, as Stephen pointed out? Maybe not. Just to add one more data point to what Stephen pointed out, only 15% of American companies actually show us what their labor costs are. This is shocking, absolutely shocking. Before we talk about human capital and all the other good stuff, please at least tell me what your labor costs are. I'd be grateful. You know, the other takeaway for me, you know, I hadn't appreciated how much healthcare, how well healthcare does, which is interesting as a benchmark to digital. Subject to Sudipta's and other comments, we haven't factored in, you know, some kind of risk premium for failure, which we should at least do something about. And you know, at least if nothing else, it's a modest contribution to try and put some kind of bounds around the regulatory concern, and especially the finance econ estimates of 200% ROIC and so on for Microsoft, which is just bizarre. Predictably, nobody here is from finance. So again, I hope we're not talking in our own echo chambers, and they won't read our papers and they'll reject it anyway. But it's worth fighting the good fight, regardless. So. Oh yeah, one more thing. Ayung was very insistent I should advertise the next one. So the next paper is next week's talk is by Joshua and Amadeo, and they're going to talk about banking and stress tests. And this is the Zoom link. Ayung, do you want to pitch in?
Yeah, thank you so much. So next Thursday, hopefully we will see all of you again. Thank you, Shiva.
You know, yeah, given the constraints, as Ayung said, you know, we have to stop here, but I'm more than happy to talk offline if anyone wants to be, you know, wants to engage, because I think it's an interesting question. And the whole area has plenty for people to contribute to. You know, this is a deeply difficult problem, and this is our bread and butter, measurement. So let's not cede intellectual territory to these other guys, you know. Anyway, that's my closing statement, if you will. And thank you again, Ayung, for the opportunity.